And welcome back. The Federal Reserve increased the federal funds rate by 25 basis points on Wednesday. However, investors seem to be more focused on what Jerome Powell had to say rather than the increase in rates which were expected. Which, by the way, the Fed does not control mortgage rates. Instead, they control the federal funds rate, which is the short-term rate that banks charge each other for overnight lending. Now, have a look at this. This is according to the National Association of Home Builders. They say here the Fed raises rates again, but takes on a more dovish tone. So take a look at this as well. This is really interesting. This is according to CNBC. They actually compared their statement by the Fed that was posted on February 1st compared to Wednesday's statement here. It says here there are notable changes from February's meeting, a shift away from ongoing increases to the policy rate to some additional firming. In other words, going from ongoing increases in rates to some additional firming in rates. And CNBC actually provided a document showing how February 1st statement compares to Wednesday's. So text below here appearing for the first time in this new statement from Wednesday is actually in red and underlined. Bold text appears in both statements from Wednesday and also compared to February 1st. And here is the main change in my personal opinion here. It says the committee anticipates that ongoing increases in the target range. That was what they said back in February 1st. And here's what they say in today's statement. The committee anticipates, rather than ongoing increases in the target range, the committee anticipates some additional policy firming may be appropriate in order to attain a stance of monetary policy that's restrictive in order to get to inflation to 2% over time. So going from ongoing increases in the target range now to some additional policy firming may be appropriate. Therefore, the Fed appears to be more dovish in their tone regarding future rate hikes by the Fed. They also stated here the following here. It says, rate hikes are not in our base case for the remainder of 2023. In other words, they do not plan to cut rates for the remainder this year. So the result of these statements by Fed Chair Jerome Powell caused the 10-year Treasury to fall today, down to 3.44% on March 22nd, down approximately 16 basis points compared to yesterday. And take a look at this as well, because this caused average rates for mortgages to fall big time today as well. The average 30-year fix falling to 6.45%, a decrease of 30 basis points compared to Tuesday. And look at rates for FHA and VA. You can get an FHA loan or a VA loan at around 5.8% right now, or you can get a 15-year fix at 5.95%. So here's a chart showing average 30-year fix rates going back to February 1st this year. So at 6.45%, this is actually the lowest rates going back to February 9th this year. And here's a look at rates over the past 7 days, which, by the way, mortgage rates have been absolutely all over the place this year. So right now, again, rates are at 6.45%. Again, this is for people with exceptional credit, of course. 6.45%, a decrease of 30 basis points compared to yesterday when rates are at 6.75%. However, having said that, even though rates have decreased big time compared to yesterday, we're still up by quite a bit compared to 1 year ago. Rates 1 year ago were at 4.72%. In other words, average rates have increased by 173 basis points from 1 year ago. Taking a step back here, though, this 1.73 percentage point increase in rates compared to 12 months ago is not nearly as bad compared to late October last year. Back in late October, rates were around 7.4%. And 12 months prior to that, rates were around 3.3%. Therefore, back in October, rates have increased by about 4 percentage points in the last 12 months before that. Now they have increased by less than 2 percentage points. Going back to the Federal Reserve's statement today, here's what they also stated as well. It says the U.S. banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households. These challenges will result in tighter credit conditions, which will slow the economy and reduce inflation. Now, something you guys should be aware of is that credit conditions right now are already very, very tight before the statement by the Fed. So here's a report that was posted about a week ago from the MBA, or the Mortgage Bankers Association. It says here, back on March 14th, mortgage credit availability decreased in February according to the Mortgage Credit Availability Index, or their MCAI. A decline in this index indicates that lending standards are tightening. According to Joel Kahn, who's the MBA's vice president and deputy chief economist, he says credit availability decreased to its lowest level since January of 2013. And again, this is based on their index for February after Jerome Powell's statements that we may have to tighten household credit availability further here. He also says the conforming index, which is index based on conventional loans, for example, their index for credit availability for that decreased 4.3% to its lowest level in this survey, which goes back to 2011. So in other words, credit availability for conventional loans, for example, is at its lowest reading going back to 2011. He also says here, in this volatile rate environment and potentially weakening economy, there was also a reduction in refinance programs offered to low credit score and high loan-to-value borrowers. Here's a look at credit availability going back to 2011 for all loan types, by the way. As you can see right here, the onset of COVID, lending standards got tighter and tighter. Again, a decrease in their index means that lending standards are getting tighter and tighter. And the current levels we have right now, at least for February, is more or less on par with 2013. In other words, the tightest lending standards we have right now going back to January of 2013. And have a look at this, because this is absolutely insane. This is looking at their index going back to 2004. Look at 2006. In 2006, their index was approaching 900. Now it's only 100. So lending standards we have right now are very, very tight, especially compared to 2004 through 2007. And again, the current levels we have right now is more or less the lowest levels going back to January of 2013. Also, when looking at some early indications of home buying demand, take a look at this. This is according to the MBA, which was just posted on the 22nd of March. It says here, mortgage applications increased 3% compared to the previous week. And this was for the week ended March 17th this year. Of course, applications includes refis plus purchases though. So the refi index increased 5% compared to the previous week, but was down a whopping 68% compared to the same week 1 year ago. That's refis. Let's have a look at purchases though. So applications for home loans to buy houses actually increased 2% compared to the previous week, but still down by 36% compared to 12 months ago. According to Joel Kahn, he stated the following. Treasury yields declined last week, driven by uncertainty over the health of the banking sector and worries about the broader impact of our economy. Mortgage rates declined for the second week in a row, with a 30-year fixed rate dropping to 6.48%, the lowest level in 1 month. Both purchase and refi applications increased for the third week in a row as borrowers took the opportunity to act on these lower rates. However, though, overall application volumes remains at relatively low levels. Yet another leading indicator of our housing market is this right here. This is according to showingtime.com for real estate showings across North America. So for the week ended March 21st, which by the way, this is a 7-day moving average. For the week ended March 21st, home showings increased by 18.5% compared to the first week this year. Compare this to last year, we had a gain of 22.1%. Then in 2021, compared to the first week of 2021, there's a gain of almost 38%. So I found this to be very interesting that we had an increase of applications for home loans for 3 consecutive months. And also home showings across North America this year are not too much far off last year's levels. Now, having said that, fewer people are searching for homes for sale on Google. So right now, there's approximately 16% fewer searches for homes for sale right now compared to 12 months ago. Also, the interest over time for homes for sale on Google has been more or less flat all year. And lastly, one more thing I would do want to share regarding some early indications of home buying demand right now is this right here. This is according to Redfin for the month of February that was just posted about a week ago. So pending home sales on a seasonally adjusted rate here decreased by 26% compared to February of 2022. Approximately 26% fewer contracts being signed between buyers and sellers. Also, Redfin looked at 91 US metros that had a population of at least 750,000 people. So out of those 91 metros, only 4 metros posted increases in pending home sales on a year-over-year basis this February. Those 4 metros were Dallas, an increase of 3%, Buffalo, New York, a gain of 2.9%, Indianapolis, Indiana, a gain of 2.3%, and Cincinnati, Ohio, an increase of 1.3%. So out of these 91 US metros, only 4 metros recorded increases in pending sales from 1 year ago. In contrast, in Baton Rouge, Louisiana, pending sales fell 69% year over year, more than any other metro that Redfin analyzed. That was followed by Allentown, Pennsylvania, down by 54%. Honolulu, Hawaii, also down by 54%. Greensboro, North Carolina, down by 49%. And Las Vegas, Nevada, a decrease of 47.9% in pending home sales compared to February of 2022. So I'd love to hear from you guys. What do you guys think about rates decreasing by 30 basis points on the 22nd? The lowest rates in approximately 1 month. Is this going to cause home buying demand to increase further? Or will it decrease given the fact that rates have increased so much over the span of the past 12 months? Please comment below. I appreciate you guys watching this video. And of course, I appreciate you guys in general for supporting my YouTube channel. Hope you guys have an awesome day. I look forward to seeing you on the next video.